All right, all right, all right, all right. We are up on X. We are waiting for YouTube and Twitch, and there we go. So, thank you for everybody chiming in today. We're going to look through the Dutch Bros earnings calls. And for those of the people that have been watching after hours, I want to congratulate Hood investors, the people that were following on Amit's channel and Tanner's channel as they went through the Hood investment. Congratulations to those guys, because obviously the stock has done extremely well in the after hours. I personally haven't had the opportunity to look through. I'm keeping track of companies that I own more of, which in this particular case is the Bros, Dutch Bros. For those of you guys who have been looking after this, we've been investing in this one for a little bit over a year and a half. I think since August-ish of 2023, we started covering it on the channel, Cash Flow Chronicles, about 18 months or so. I've written a couple articles on Seeking Alpha about it. We've talked about it pretty extensively. I have one near my home. We've been chatting about it off and on. So for those of the people that have been following, just wanted to provide this opportunity for an update on it, because I know some people are following it, and I'm also into it as well. I looked at the financials so far. I initially was very surprised by this 23% jump. I obviously thought that we were going to be hanging out in the 50 to 60 range for a little bit longer. I do think that this valuation is a little strong, but I can understand where the positive sentiment is coming in from a Wall Street perspective. And I think I found the reason why. Everyone is very excited about the stock. It's the same reason why it popped in the third quarter. And to be very frank, I think a lot of it has to do with slowing down a little bit in terms of the expansion of stores. And while they met their goal for the year, if I remember correctly, while they met their goal for the year, as if I'm correct, let me just kind of go back and double check. At the same time, they have been doing really well with respect to EBITDA margins, and they've been doing really well with just getting things up to speed from that perspective. And so to me, I think that while they're pulling back, initially people were very frightful about that and what that meant for future growth expectations of the organization. I think it ended up playing in their favor, because right now the name of the game, if anybody's been paying attention to small caps and stuff of the like, is making sure that you're self-sufficient, making sure that that you're good. And what I will say is that, at least from what I've seen, contribution margins to the bottom line are continuing to stay as expected. And so with that, we're looking pretty good. So they met above revenue. So to give everyone some context, they're supposed to be about 1.25 to 1.26 billion in revenue for the year, 150 store openings, same store sales growth of approximately 4.2%. And with the fourth quarter, they're supposed to be between 1 and 2%. Adjusted EBITDA between 215 and 220 million. SG&A about 195 and 200. For those that don't know what SG&A is, sales, general, and administrative costs. Capital expenditures between 245 and 265. Now, this 245, 265, very important number, because I think had this number actually met 245 to 265, I think we would be in a different situation with the stock right now. So I'm kind of curious, scratching my head a little bit, trying to understand if this is going to impact future store growth in 2026 and beyond, 2025, 2026 and beyond, knowing that obviously some of this stuff takes time, right? You can't just put a building up within a quarter. You have to invest, 12 to 18 months before you get the building up and running. And so in that respect, I'm kind of curious and scratching my head a little bit about, it takes a little bit to pull back a little bit in the short term, get yourself in a better place with respect to cash flow, etc. And then in the long term, that obviously plays well as you can slowly start to increase as your EBITDA increases, etc. So let's get into the actual numbers themselves. Thank you all for joining me, the 120 people that have clicked on X, the 44 folks that are joining here on YouTube. And let's just go through the actual numbers themselves. It's a pretty interesting story this quarter. And in this respect, I wasn't really expecting a lot of this revenue growth that showed up. But hey, here we are. And you can't complain with that. And we'll build that momentum going into it. Do I think the valuation is a little stretched? Of course. But Right now, valuations are stretchy for a lot of companies. We'll see when things kind of come back to earth. But in this case, I think it warrants it a little bit, and we should celebrate, right? I wasn't expecting 35% year-over-year revenue growth for the fourth quarter, over 30% for the entirety of the fiscal year 24. Remember, we were expecting about 4.5% or so same store sales growth, delivered 6.9 for the entirety of the system. That's franchise coupled with the company operated stores, and then 9.5 specifically for company operated stores. This gets broken down into volume as well as ticket sales. So keep that in mind. So increased amount of tickets, so amount of throughput, etc. And then also it gets measured on the fact that you can increase prices as well. So we'll talk a little bit about that in a little bit as well. So there's that respect of things. Opened 32 new stores in the fourth quarter. The total revenues grew 35% to 340 million, which on a run rate, if you add all that up, looking pretty bueno, right? About 1.4 billion on a forward-looking basis. But of course, we're going to continue to grow. Company operating revenue is up 38%, which is phenomenal. 314 million compared to 227 million, so a huge increase there. Net income, I think, is still the kind of sore point for the company, but they do have a lot of depreciation costs associated with the real estate, so that's a part that you kind of need to factor in. EBITDA, I think, is what the real star is coming out, and not necessarily just from the quarterly perspective, although that was up expansively from 34.6 million to 48 million, just under 50 million here. The real, I think, important piece is to look at when we get to cash flow, and we'll talk about that in just a second. Let's see. Net income 7 cents a share versus 4 cents a share in the same period last year. So up about, what is that? 75% year over year in that respect. And of course, common loss on a non-adjusted basis was negative last year, and now we're up 3 cents comparatively. So for fiscal year, obviously we hit 1.28 billion. So about 20 million more than expected, grew 32%, almost 33% year over year from 965 million to 1.28. That beats my expectations, that's for sure. Same store sales increased 5.3, which is huge. And we'll talk a little bit more about that and the breakdowns when we go forward. SG&A was 15.8% of revenue. That continues to go down in the right direction. You can see it was 16.5% last time. Net income 66.5 compared to 10 million. So trending in the right direction, but still, when you're talking about a $10 billion company, 66.5 million, it's a little expensive. We could talk about that going into the future. But this is the important part here. Increased 44%, adjusted EBITDA 230 million. And this number is important, this 230 million, because keep in mind, CapEx was forecast to be about 260, if I remember, 245, 250, north of 230 million, right? So we were expected to, on a cash in, cash out perspective, be negative for the year. If that's the thing I want to highlight here. Revenue guidance for next year between 1.555 billion and 1.575, getting real picky about the significant figures here. Total system shop openings expect to be about 160, so about 10 more than last year. CapEx estimated between 240 and 260. Once again, 240, 260 is an important number. Same store sales growth estimated about 2 to 4%. Keep in mind that breaks down, so we'll talk about that when we get into the numbers. And then adjusted EBITDA 265 to 275. So we'll be cash flow positive going into 2025 per basis, and this includes elevated coffee costs. So let me just break this down for you. Before we listen to the conference call, lose you guys, I want to talk about the most important piece. And now first I was that's heavy off the back of 3Q. And let me get you to what I want to show you here on the earnings reports here, and hopefully I'm not losing you guys. Hopefully I'm not losing you. If you keep giving me great ideas for stocks to buy, I'm gonna have to go back to work. What does that mean? I don't even know what that means. How would you have to go back to work if I keep giving you stocks to buy? this is the thing I was most looking at here. So remember, EBITDA for the year was supposed to be, if I remember correctly, between 225 and 230 or something of the like. We ended up at 246 in terms of ops cash, right? I know EBITDA and ops cash are not like for like, but you guys hear what I'm saying. You know, they're similar enough where 246 is a phenomenal number to come in the door. But if you remember correctly, we were supposed to lose cash this year on a cash flow basis and spend more than we made. That's not the case. We made 246 million of ops cash coming in. We spent 212 million. Yes, we did do some financing activities earlier in the year, so that's what this 125 is coming from. So yes, they did add money to the balance sheet in that respect. But the fact that they brought in more ops cash than they spent in capital expenditures, very positive. Over 30 some $million here being added. Muy bien, right? This 125 isn't necessarily where we added, if that makes sense. We added 159 million. That's the difference between this ops cash from activities versus what we spent on capital expenditure plus this 125. So this 30 odd million plus this 125 gets to the 159, almost 160 million. We're building cash in the organization. Even if you were to remove this 125 million, you would have went from this 133, the ending amount in year end 2023, and you would have ended up with about 160, 170 million dollars in cash. We didn't necessarily need to raise this, but I think this is a decent buffer. I think this gives an opportunity to do exactly what I was kind of saying, which if you look, I think they were forecasting north of 227 million in terms of total spend. I think they were looking 245 to 255, I think was the capital expenditure expectation for the year. So one of two things: they're either getting more efficient at the costs the capital expenditure per building, or they're pulling back in future capex for 26, 27, 28, etc. And this might have knock-on effects. But that being said, 150 stores is 150 stores. Next year is 160 stores. So if you're building off this 246, you're going to grow it, say 20, 30% next year again. Your ops cash is going to look phenomenal, and that way you can gain and increase slowly with time. So originally, I think where my forecast was kind of hitting was mid 25, late 25 was when we were going to get to this point. But if you remember, Dutch Bros had like a little bit of a slump. It got into the 50s, and they had like a 1 or 2 Q earnings call. They were talking about how they're going to pull back a little bit on the real estate spend. They're going to try to optimize it, etc. That was not well received by the market, if I remember correctly. But now in 3Q, 4Q, the opposite end is coming around to say, you guys are ops cash positive, right? Ops cash flow positive. So in that respect, you're bringing in a crap ton of ops cash. You're not spending as much, so you don't necessarily have to be dilutive or anything like that to provide that cash. And I think that this is particularly what the market is harping on at the moment. You're going from 133 million to, even if you offset this 125 million of financing activity that they did earlier in the year, still would have built 35-40 million dollars worth of cash on the balance sheet. So I think this particularly is what everyone's excited about when they're looking at Dutch Bros. That I think was rewarded in 3Q and has been rewarded again in 4Q. And my thought process was like, okay, well, this is a full year number. Is 3Q the benefit that we saw in 3Q that everybody was ranting and raving about when the stock went from 45 to 65, like in a matter of a month or two? Is that really what was carrying the burden here? And so I was like, okay, well, let me go into 3Q and just double check that we're not double dipping here, where everybody's all fired up about where is it? Where everybody's all fired up about the third quarter earnings report and the cash flows to date. Let me pull it up. And at the end of the day, we ended up still technically being down for the year, and the answer is no, right? So if you just look at what happened, they were at 184, and this was, I think, near 9 months ended. This is offsetting, keep in mind, the first 2 quarters where it was negative. Ops cash provided was about 184. And at that point, we had invested about 169. Let me just double check I'm sharing the right one. Yeah. Um, so that was the big bump that we saw in the third quarter. Everyone was excited. Yes, you had this 132 million of financing cash. This actually decreased a little bit towards the end of the year. But what you ended up having here was a slowdown, in my opinion, of the capex for the fourth quarter. Was that intentional? Maybe, but if you look here, this is only a $15 million delta through the first 9 months of the year, and this grew an additional 15 to 20 million going into the fourth quarter. So we're on positive. We're on positive, right? We were at 281 in the third quarter, and then even still, if you look at the fourth quarter, we built another 12 million into this. So in that respect, guys, this is going back to the full year instead of the 9 months that we were just looking at. Muy bien, right? Like muy bien. That's really it. Like if I were to summarize everything, you could talk everything to Kingdom Come about what else is on there, what go through and look at specifically how much you're growing in terms of stores, etc. The things that I saw were ops margin is kind of staying flat-ish at 29%. It's not deteriorating, even though you have rising input costs like coffee, etc. But you are still massively growing the top line. Menu prices isn't deterring people, which is interesting, which maybe we could hint on or dive deeper on when we go through the investor presentation. But overall, things look rather good, and I guess I might as well the things that I want to show in here briefly in the investor deck. Here we go, 212. Let's go investor deck presentations, supplemental deck show. I could go through this to Kingdom Come, guys, but I'm not going to. I maybe at a different date, but a decent growth, 44%, 70 million in total year over year. Really good and well received there. The margin from 23 to 24 increased. That was something that was beneficial. From 3Q to 4Q, from 3Q to 3Q, it went down, but overall, fiscal year 23 versus fiscal year 24 did go up. But keep in mind, from 2022 to now, it went all the way up to 30 at one point, and now it's slowly starting to come down. So I'm watching that. It's giving me pause. I'm looking at it. I'm watching it. I was happy to see that it was flat quarter over quarter from 3Q to 4Q. And let's just kind of hope that persists. The thing I'm going to highlight here before we get into the conference call is same-wide sales growth is kind of two different things. There's a total amount of transactions, and then there's the ticket. So actually from 22 to 23, you saw a decrease. No bueno. But for full year, keep in mind, this is total systems and there's company operated. Total systems fiscal year, you're seeing about flat. You're seeing 1.5% total company operated stores going up. So about 1.5% more traffic per people, which keep in mind, they're doing mobile rollout. They're doing a lot of other things. That's keeping numbers up. Went way up in the fourth quarter. Otherwise, this probably wasn't going to look very good because of this drag that you had in Q2. But with that, you have ticket sales, total like menu items and things of the like. They're trying to offset labor costs. That's up 5.3%. So what do I mean by that? So you have 28% in terms of the contribution margin. Just make sure I'm not even sharing. Jesus Christ, guys. Let me go back and show this particularly. I was basically talking about the adjusted EBITDA growth, 70 million, 44% year over year, but really same store sales growth overall up 5.3%, flat system wide in terms of total transactions. But if you look at company operated stores, which is generally speaking what they focus on for the business, because they can't really control the franchises all too much. The total value was up 6.8% compared to 5.3 system wide, but the majority of that is coming from increased ticket sales. So higher menu prices is kind of what I like to think about it as. And the total number of transactions is important to see, because if you're raising ticket prices and transactions is going down, can you at least offset it? So what you're seeing here is specifically company-wide, not company-wide, system-wide, including franchises. They were able to increase prices very substantially in the first quarter of the year, and that kind of had a a follow-on effect throughout the remainder of the year. But overall, numbers were flat, dragging mostly from 2Q. So I'm not sure if it was just abnormally cold, or it's just a difference in, let's just say, the different stores that you're investing in. So this is maybe more southern stores, maybe more Midwestern stores. And so that might be a little bit more of a drag than if you're on, say, the West Coast, where weather might be a little bit more favorable. I don't know. I don't know the answer. I'll have to listen to it in the conference call. But overall, 1.5% overall ticket sales going up, or sorry, ticket count going up, but 5.3 total sales in that respect per ticket. So you combine both of those, 6.8%, and that's where they get that big number. So keep in mind the actual graphic here. This is what I was talking about a little bit with respect to labor costs associated with West Coast being a big contributor to where a lot of the Dutch Bros stores are. And then you had an offset in menu pricing. So this has been exacerbated if you look at it from 2022 to 2024 with menu prices and labor costs. Keep in mind, minimum wage increases have gone into effect in a lot of the Western Coast states. And so it's being partly offset by the fact that you're moving east into the South, where labor costs are a little bit cheaper. But I'm curious if this gets exacerbated as you go closer to the East Coast, and maybe you end up having more minimum wage growth over there as well. I don't know. But menu costs has been something that they've been embedding, and I've noticed it for sure. Normal beverages I used to get $5-6, now they're $7-8. I'm like, damn, I'm not getting that again, right? So that's something to consider. I've definitely slowed down the amount of bros I'm getting personally. Maybe it's just because I got too excited. It was close by, wanted to, instead of driving 15-20 minutes like I used to in the past, now it's just a 5-minute drive. So I made it a little bit easier. But at the same time, I'm like, $6 a pop, $7 a pop. It's not cheap. So I'm sure at some point they'll hit some sort of inflection point and people will start pulling back. And I think system-wide, you actually saw that, right? System-wide, you saw it was flat. And so if they continue to get aggressive, maybe at some point this transaction number actually goes down and might provide an opportunity in the long term to buy the stock. But yes, there's a bunch of different things. The fiscal year outlook, I think we already talked a little bit about that. 160 stores, 1.57 billion in revenue expected. Same store sales growth of 2 to 4%. EBITDA 265 to 275. So once again, covering the capital expenditures. But once again, I wasn't expecting this to be covered until this year. They previously were forecasting EBITDA to be much less, and CapEx in fiscal year 24 to be much more. So interesting to see, but we're going to hopefully ride this train. But the CapEx is going back to kind of more normal. It was 225 to 235, if I remember, and EBITDA was supposed to be about break even throughout the year, maybe slightly below that. And now we're obviously surpassing it. So we're hitting this inflection point where hopefully one of two things either happens. They had that 4,000 store goal, which right now they're at about 1,000 stores, 985 as of this quarter. But my question would be, are you talking about specifically company operated stores of 4,000, system wide stores of 4,000? Because if you're only putting in 160 a year, it's going to take some time. I mean, even if you get to 200, you have 3,000 stores, you're going to take 15 years at 200 stores. So you're behind in terms of that. So anyway, with that, let's hop over into the earnings call. Let's see what you guys think.
Thank you for standing by, and welcome to the Dutch Bros Inc. fourth quarter 2024 earnings conference call and webcast. This conference call and webcast is being recorded today, February 12th, 2025, at 5 p.m. Eastern Time, and is available for replay shortly after the call is concluded. Following the company's presentation, we'll open up the lines for questions, and instructions to queue up will be given at that time. I'd like to turn the conference over to Patty Warren, Dutch Bros Senior Director, Investor Relations and Capital Markets. Please go ahead.
Good afternoon and welcome. I'm joined by Christine Barone, CEO and President, and Josh Gunzer, CFO. We issued our earnings press release for the quarter and year ended December 31st, 2024, after the market closed today. The earnings press release, along with a supplemental information deck, have been posted to our investor relations website at investors.dutchbros.com. Please be aware that all statements in our prepared remarks and in response to your questions, other than those of historical fact, are forward-looking statements and are subject to risks, uncertainties, and assumptions that may cause actual results to differ materially. They are qualified by the cautionary statements in our earnings press release and the risk factors in our latest SEC filings, including our most recent annual report on Form 10-K and quarterly report on Form 10-Q. We assume no obligation to update any forward-looking statements. We also reference non-GAAP financial measures on today's call. As a reminder, non-GAAP measures are neither substitutes for nor superior to measures that are prepared under GAAP. Please review the reconciliation of non-GAAP measures to comparable GAAP results in our earnings press release. As a reminder, we will be hosting our inaugural Investor Day on March 27th, 2025, in the Phoenix, Arizona market. During this event, our leadership team plans to discuss our competitive differentiators and growth plans. We also anticipate providing updates to our long-term financial plan. On today's call, we plan to discuss our performance in the fourth quarter 2024 and provide guidance on certain key metrics for 2025. Following our prepared remarks, there will be a question and answer session. We would ask that questions please be focused on these topics as we plan to cover longer time horizon topics next month at our Investor Day. With that, I would like to now turn over the call to Christine.
Thank you, Patty. Good afternoon, everyone. Dutch Bros' future has never looked brighter, and we saw that represented in our 2024 results. Revenue growth in 2024 was outstanding. We delivered 33% total revenue growth, driven by a healthy balance of 18% new shop growth with 151 new shop openings and 5.3% system same-shop sales growth in the year. New shop performance is strong and improved considerably throughout the year. We enter 2025 with heightened confidence in the size of the brand's white space and the ability of our development and operations teams to execute upon it. Adjusted EBITDA grew 44% in 2024, driven by strength in our four-wall P&L and continued adjusted SG&A leverage. We have made and will continue to make the investments in people and capabilities, which we believe only compounds our competitive advantage. I am incredibly excited about the strength of our brand, the love from our customers, and our clear path forward. As we survey the industry landscape, we believe Dutch Bros is uniquely positioned and on trend with an emphasis on iced beverages, personalization, and speed. We see an increasing relevance of the customized energy occasion, which has been core to our menu for over a decade. We also see the continued importance of genuine connection, embodied by our Broistas and a cornerstone of Dutch Bros for the last 33 years. Zooming into Q4, we saw substantial momentum across the board. Our brand is resonating with customers. In Q4, we saw 6.9% same-shop sales growth, as well as our largest quarterly transaction growth since 2022. Company-operated same-shop sales grew 9.5%. We experienced our first full quarter of mobile order and are beginning to see the benefits to our business. In Q4, we returned our holiday favorite LTOs, Hazelnut Truffle Mocha and Candy Cane Mocha, offering our customers a spirited way of staying engaged during the holiday season. We saw the highest performance ever of our Candy Cane Mocha platform, where we sold almost 40% more total units than when we ran it last year. Our enhanced marketing efforts continue to build brand awareness and gain traction, and we are seeing great engagement and response in our Dutch Rewards program. Our real estate strategy is working. Once again, we saw strong new shop productivity as we have shifted our development focus and elevated our site selection process. And we continue to demonstrate remarkable consistency in our shop opening cadence with 32 new shops in the quarter. Our pipeline for 2025 is strong. Our efforts are translating to outstanding financial results. In the quarter, we drove a 35% revenue increase and a 41% adjusted EBITDA increase compared to the same quarter last year. System-wide AUVs were $2 million, in line with the record we posted earlier this year. This month, we are celebrating a major milestone as we open our 1,000th shop. We are extremely proud of our results, and I would like to take a moment to sincerely thank our entire team. Our Broista teams wake up early and stay up late to make a massive difference one cup at a time. And our 2024 results are a reflection of this effort during each shift and each interaction every day. I'd now like to spend some time walking through our key growth drivers, beginning with how we grow our people and scale our culture. Our people are the cornerstone of our strength. Our talented Broistas and the service they provide drive our growth and separate us from competitors. One of the reasons we have chosen to grow primarily through a company-operated model is because we believe it enables us to scale our culture as we enter new markets. We make big investments in seeding our culture as we expand, and we are pleased with how this is translating into strong service. Our people pipeline includes more than 450 regional operator candidates, with an average tenure of more than 7 years. For context, we had approximately 200 operator candidates in our pipeline at the end of 2021. It is important to note that in addition to almost doubling our shop count during this period, we also significantly expanded our operator candidate pipeline. We are able to attract, train, and retain great people and continue to build a strong foundation for growth for many years into the future. This approach also enables us to create compelling futures, providing opportunities for Broistas to grow with us. In 2024, our overall shop level turnover improved approximately 5 percentage points year over year. We are honored to be an employer of choice and blown away by the excitement of applicants seeking to join us as Broistas. In December, we had the opportunity to reinforce our culture by hosting our shop leadership at an event we called A Better World. Almost 3,000 of our field leaders, franchisees, and headquarters team were able to attend and experience this catalytic cultural event, many for the first time. The energy was electric, and the team left with a renewed sense of purpose and clarity of mission. In mid-December, Venki Krishnababu joined us as our Chief Technology and Information Officer. Previously, Venki served as Chief Technology Officer at Lululemon Athletica and brings nearly 30 years of experience leading transformational, enterprise-shaping strategies and a proven track record of creating business value through technology, innovation, and partnerships. I'll now shift to how we are growing our shop base and capturing our white space. We are executing our real estate strategy and are very energized by the results. New shop productivity continued to increase in Q4, which we believe was a result of enhanced market planning as well as elevated paid ad spending in new markets. Once again, we delivered our shop development target in Q4 with 32 new shop openings, bringing total shop count to 982. For the year 2024, we opened 151 new shops, of which 128 are company operated. We have a strong 2025 pipeline. In the second half of 2024, we made investments in our development, construction, and market planning teams and continued elevating our site selection process. These investments, combined with our extensive white space and strong four-wall model, elevate our confidence in our pipeline in 2025 and position us to accelerate quarterly unit growth in the back half of this year. Now I'd like to discuss our efforts to grow transactions and develop sales layers. Early in 2024, we outlined a transaction-driving strategy focused on 3 foundational initiatives that we plan to use to jumpstart transaction growth: enhanced focus on innovation, increased paid advertising designed to build brand awareness, and more targeted rewards program efforts. We are executing on all these elements, and we are seeing success. Transaction growth accelerated as we exited the year, reaching 2.3% for the system in Q4. Our efforts are working, and we believe we have considerable runway for further growth. Here is a brief update on the 3 foundational traffic driving initiatives. First, innovation. In the competitive beverage industry, we believe staying ahead of trends is critical. We utilize innovation to build sales layers and deepen our competitive moat through category-defining products. In the quarter, we returned the successful LTO offerings Candy Cane and Hazelnut Truffle Mocha, and added Jingle Nog and Winter Shimmer Rebel as seasonal offerings. Furthermore, we continued our strategy of utilizing promotional innovation to surprise and delight our customers with giveaways like the Passenger Princess Straw Topper and our custom holiday ornament. These were huge hits that drove both excitement and sales volume. We love doing these innovative promotions as it strengthens our brand loyalty and creates extra moments of connection with our customers. Second, paid advertising. It is becoming increasingly clear that our upsized paid advertising investments are having a positive impact on our business. We saw an opportunity to raise brand awareness in new markets, and we began increasing our digital ad spend. Those efforts have been successful. We have seen considerable improvements to both brand awareness and traffic. During the second half of 2024, we expanded this program to build greater awareness in mature markets. We are encouraged by what we are observing in these markets as well. And third, Dutch Rewards. We continue to see exceptional traction in the Dutch Rewards program, with a record 71% of transactions coming from Dutch Rewards members. This is an increase of over 500 basis points year over year. In the back half of 2024, we accelerated our segmentation efforts, which we believe will enable us to reach customers more efficiently and provide even more personalized and relevant offers. While we are still in the early innings, the responses we have seen to date and the opportunity we see in front of us are encouraging. Beyond these three foundational transaction drivers, we see a clear path forward with multi-year initiatives that layer on top of this foundation, including food and mobile order. We continue to be excited about mobile order, and here are a few program updates. As of December 31st, approximately 96% system and 99% company-operated shops have mobile order functionality. Our customers are enthusiastically embracing the mobile order occasion. As of December 31st, our rewards customers have placed approximately 5.4 million mobile order transactions. Mobile order continues to over-index in the relative rush of the morning, and in particular with coffee-based beverages. This gives us confidence that we are on the right track with our strategy to further unlock the morning daypart with greater convenience. And finally, we believe mobile order contributed to the traffic outperformance we experienced in Q4. As of December 31st, approximately 8% of our channel mix was mobile order, representing a steady and deliberate increase quarter over quarter. We continue to observe that customers who use mobile order increase their frequency, and mobile order penetration is more than twice the level of our overall system in some of our newer markets. We believe that by placing the convenience of the digitized menu in the hands of our customers will bode well for us in newer markets, as it allows customers to explore and learn our brand. Last quarter, we announced that we began a limited food test. This initial test has been focused on understanding the optimal assortment and how an expanded food program interacts with our existing operations. Although the test is small, initial signs are encouraging and point towards the viability of an expanded program. As we consider a food program, I'd like to share our guardrails. First, Broista job satisfaction. As we expand their roles, we must consider how to do so in ways that continue to foster a fun and energetic work experience that assures we continue to attract.
So I just want to say this part's very important, right? Because Dutch Bros is very much about not only the fact that they want to provide good customer service, but also they're very people-oriented with respect to their business. They want to hire from within. They want to hold people within, retain them for the long term. They want to make sure that they're happy. So in this case, at the moment, they only have prepackaged goods for food. They have 3 different choices of muffin tops, which are very delicious. I've had all 3 of them. The chocolate chip's really good. Lemon poppy seeds very good. And they have the cranberry one, which honestly I didn't think was going to be very good. I'm not normally like a cranberry kind of guy, but I thought was also very good. They don't have a blueberry now that I think about it, which they should. But the chocolate one's just like phenomenal. And then they have the fourth product, second differentiated product, which is the granola bar, which is also the best granola bar I've ever had. So with respect to that, it's very easy for them to just go in the fridge, pick it out, and then hand it to you, not necessarily disrupting too much of their day to day. So I'm very curious to hear more about the food rollout, because I think it's a fine line between providing food like you have at Starbucks, which can kind of be hit or miss, and providing something that is massive. And then are you playing up against McDonald's and stuff of the like? And while I'm on here, Sam, thank you so much for becoming a member. Be sure to check out and get in the WhatsApp group where we're chatting about this stuff all the time. So please and thank you for joining. And anybody else, don't feel obligated to join, but of course, would love to provide you guys insights throughout the day, which normally, unless you're watching my tweets or anything of the like, I don't necessarily have too much time, but I prioritize the WhatsApp group, and it's fun. We have a good conversation in there. So, all right, back to the earnings call.
And retain the very best people. Second, a targeted assortment focused on capturing the food attach opportunity and the potential incremental beverage opportunity while minimizing complexity. Third, no impact to throughput. We believe we have an opportunity to expand market share in the morning day part. We understand that many people seek the added convenience of a food pairing with their morning beverage choice. Food makes up less than 2% of our total sales, and we are likely missing morning beverage transactions from would-be customers who are not satisfied with our current food offerings. With the expansion of our food program, we are targeting these incremental beverage occasions and aim to compete more aggressively for these high-value, routinized occasions with a limited food offering that fulfills our customers' needs. In closing, we are incredibly well-positioned with a great brand and wonderful people. Momentum in the business is strong. We believe our runway is long and our path forward is clear. We have top-tier growth. In Q4, we delivered 35% year-over-year revenue growth and 32 new shop openings. We have multi-year visibility on key initiatives, including our core foundation of innovation, paid media, and Dutch Rewards, and exciting growth opportunities with mobile order and food. Our real estate strategy is working, and we have seen another quarter of excellent new shop productivity. This, combined with our strong pipeline, gives us great confidence as we execute our unit growth plans. We have an incredibly strong brand that is resonating. I am blown away that as we reach the 1,000 shop milestone, we have customers in mile-long lines to experience those first smiles as we open our doors in new markets. Most importantly, we have great people, anchored by outstanding, engaged Broistas and a strong pipeline of operators ready to grow with us. With that, I'll turn it over to Josh.
Thanks, Christine. I will provide a quick recap of 2024 results and then a deeper dive into Q4 2024 performance. Our performance in 2024 continues to build confidence in achieving that long runway of growth that Christine noted in her comments. For the year, we generated $1.28 billion in revenue and $230 million in adjusted EBITDA. We grew revenue by 33%, including 18% new shop growth on 151 new shop openings and 5.3% system same shop sales growth. We delivered 70 basis points of leverage on adjusted SG&A. Our adjusted EBITDA growth was 44%, and our adjusted EBITDA margins expanded 140 basis points to 18%. For the year, we delivered 49 cents per share of adjusted EPS. For the fourth quarter, revenue was $343 million, an increase of 35% or $89 million over the fourth quarter of last year. In the quarter, we opened 32 new shops, of which 25 are company operated, representing focused and intentional progress. We remain encouraged by both our new shop productivity and our overall system AUVs of $2 million. Same-shop sales performance in Q4 exceeded expectations. In the quarter, we delivered 6.9% system same-shop sales growth, of which 2.3% came from transaction growth and 4.6% from ticket growth, driven by pricing and lower discounting. We attribute Q4 transaction growth to a variety of factors, including the maturation of newer markets driven by market planning and marketing efforts to drive brand awareness, as well as the continued ramping of mobile order. In the quarter, adjusted EBITDA grew 41%. We delivered $49 million in adjusted EBITDA, an increase of $14 million year over year. Our adjusted EPS was 7 cents per share, up from 4 cents per share in Q4 last year. Moving on to our company-operated shops, revenue was $314 million, an increase of 38% or $87 million over the fourth quarter of last year. Company-operated same-shop sales growth was 9.5%, of which 5.2% was transaction growth. Company-operated shop contribution was $91 million, an increase of 51% or $31 million year over year. In the quarter, company-operated shop contribution margin was an impressive 28.9%. In Q4, beverage, food, and packaging costs were 25.4% of company-operated shop revenue. This is 120 basis points favorable year over year, driven primarily by pricing. Although coffee prices rose throughout 2024 and into 2025, we did not see a meaningful impact on our margins in 2024. As we look ahead, coffee C prices have remained elevated for a sustained period, and we expect to see the impact in our cost of goods sold in 2025. If current coffee C price levels are maintained, we would expect approximately 110 basis points of net COGS margin pressure in 2025, with the impacts beginning in Q1 and increasing in Q2. Labor costs were 27.1% of company-operated shop revenue, in line with Q4 of 2023. We anticipate making wage investments in shop leadership in 2025, which will offset the leverage we would otherwise expect on sales growth. Occupancy and other costs were 17.5% of company-operated shop revenue, which was 80 basis points favorable compared to Q4 2023, driven primarily by leverage from sales growth. Adjusted SG&A was $64 million, or 18.8% of total revenue. For the full year 2024, adjusted SG&A was 15.8%, representing approximately 70 basis points in margin leverage versus the full year 2023. We are pleased by the leverage we have driven in adjusted SG&A during the year, while we continue to staff our new office in Arizona and make targeted investments in marketing. In the quarter, interest expense net increased $709,000 from 1 year ago to $6.8 million. The increase is primarily driven by higher interest expense related to long-term debt. It's partially offset by higher interest income. In 2024, our business demonstrated consistent and measured growth, as evidenced by our balance sheet. Our Q4 results further underscore this momentum, reflecting our robust financial health and growing stability. As of December 31st, we had $293 million in cash and cash equivalents and $235 million in drawn term notes, yielding a net cash position of approximately $59 million. This is approximately $21 million higher than our net cash position for the year ended December 31st, 2023, and a majority of this increase is attributable to working capital timing. We remain highly encouraged by the substantial progress this represents towards our goal of having a self-funding business. We continue to shift the composition of our new shop pipeline towards more capital-efficient lease arrangements, but we still have work to do as we attempt to lower the per-unit cash outlay. In Q4, our average CapEx per shop was approximately $1.8 million. As of December 31st, we had $383 million in finance lease liabilities and $323 million of operating lease liabilities. During the quarter, we added $3 million in finance lease liabilities and $17 million in operating lease liabilities. We have access to ample liquidity to fuel our growth. As of December 31st, we had over $687 million in total liquidity, which we believe to be sufficient to support our growth plans. Earlier this month, we drew down an expiring $50 million delayed draw term loan to optimize flexibility, increasing both our cash and debt balance to maintain a consistent liquidity profile. Finally, I'd like to provide guidance for 2025. Total revenues are projected to be between $1.555 billion and $1.575 billion. This represents approximately 21 to 23% growth year over year. We expect to open at least 160 new shops, representing system growth of 16%. System same-shop sales growth is estimated to be in the range of 2 to 4% for the full year. As a reminder, Q1 represents our toughest same-shop sales comparison of the year, as we lap the benefit of Leap Day and our successful Boba launch. Capital expenditures are estimated to be in the range of $240 million to $260 million, primarily made up of new shop construction costs. We estimate adjusted EBITDA to be between $265 million and $275 million, representing 15 to 20% growth year over year. At the midpoint of the range, we would expect 70 to 80 basis points of net adjusted EBITDA margin pressure, driven primarily by elevated coffee costs, and partially offset by the benefit of approximately 80 basis points of adjusted SG&A leverage. Thank you, and now we'll take your questions. Operator, please open the lines.
Thank you. We'll now be conducting a question and answer session. If you'd like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 to remove yourself from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we pull for questions. First question is from David Tarantino from Baird. Please go ahead.
Hi, good afternoon, and congratulations on such strong results. My question's about the company-operated comps. Can you maybe elaborate on why you think you saw such a big acceleration in the company locations? I know, Josh, I think you mentioned maturation of new units, and I'm wondering if there was a change in trajectory there. But I guess in general, are you seeing, that being the biggest factor? Are you seeing mobile ordering, maybe being a big factor? I guess, how would you deconstruct this big acceleration you saw across the quarter?
Yeah, David, thanks so much for your question. I would start, I really think it was actually everything firing on all cylinders as we went through the quarter. And I think it starts with just the strength of the brand, the amazing service that our people and our baristas continue to provide. And then on top of that, I think we saw really all of those things working together. So we saw that rewards program, a 500 basis point increase versus the prior year. When we look at what was happening with rewards, we were seeing an acceleration in new shop adoption. So as new shops came online, really getting people into that rewards program quickly. We also saw great results from our paid advertising, especially in our newer markets. And seeing that what really drove part of that acceleration in comps in those newer shops, shops like those Texas shops coming online, really helped out. We also saw strength in mobile order. We continued to see the newer markets adoption of mobile order happen more quickly. And so that was another factor as we went through. So really a lot of things working well at the same time. We were super happy also with the innovation in the quarter. I think some of the merch drops that we did just really drove excitement for the brand. So when we look across the quarter, it's actually not just one thing, but we are actually quite happy to see everything kind of performing together with that real acceleration in the new shop performance.
Yeah, David, the thing I might add to that too is just, we did see really strong traffic performance with the result of that, with strong traffic performance, we were actually able to dial back some of our discount position as well. And that allowed us to have some strong ticket flow through. So really saw, as Christine said, really saw it hitting across the.
Yeah, I think the final factor I would add is we also saw strength in the morning. As we rolled out mobile order, the expectation was that that would really benefit the morning a bit more, and we saw that in the numbers.
Great. And if I could just ask a follow-up, I think you mentioned that, the exit rate, or maybe you made a comment that suggested the exit rate for the quarter might have been much stronger than where you started. Certainly seems evident in the results. But did that sort of strength carry over into Q1? I guess, is there any context you want to give us about the first quarter and how you expect that to play out?
Yeah, so I would say we saw strength throughout the quarter. And, as far as Q1 goes, we have seen strength in January as well. So we're very pleased with how we're starting the year.
Yeah, and David, maybe just to put a little bit more specificity as we think about 2025, our overall comp guide for the year reflects the fact that we're rolling off about 3 points of net pricing. So the net price roll off for the year would be about 3 points. And then, we are lapping 10 points in comp from Q1 of 2024. And, despite that, given what we've seen so far, we feel confident about the trajectory we're on. That full year guide of 2 to 4 contemplates about a 2 to 4 comp performance as well in Q1, and feel really good about that given what we're lapping from last year.
Great. Thank you very much.
Thank you.
This question is from Dennis Geiger from UBS. Please go ahead.
Great. Thanks, and congrats, guys. I wanted to ask a little bit on the throughput opportunity for this year. I'm sure this is something we'll hear more about at the Investor Day. But anything to share on if any of the throughput efforts are in place already, and if there was a benefit in the quarter from that, and really just kind of how to think about how impactful that might be in 25?
Yeah, so as we look at the throughput opportunity, it's certainly something we're focused on. We do have long lines in some of our shops. And as we look at that opportunity, right now, what we're very focused on is deployment. And so making sure that our Broistas are in the production zone when they need to be there, that we have the right number of runners out taking orders to match the amount of production we have. And one of the benefits of mobile order is really in helping with throughput. One, because it takes out that order time as mobile order penetration grows. And it also balances our production. And so we continue to see that more of the mobile orders are being picked up at the walk-up window than through the drive-through lane. So that is also something that helps with throughput.
That's great. Thanks, Christine. And one more maybe related to that, shifting over to mobile. It sounds like it all is going well. Just curious as it relates to sort of incrementality. You mentioned frequency still sounds really positive. If any sense on incrementality or kind of what the benefit to sales may be, if there's any way to kind of articulate that. And related, sort of as we think about the marketing here, it seems like you want to go at a generally measured pace on the mobile adoption. Just curious where we're at from a marketing perspective. Is it just the always-on marketing in the app? Are you doing anything more from a marketing perspective or not yet? Thank you.
Yeah, so as far as building mobile order, our goal here is really to have this be super stable and steady as it's adopted at our shops so that our Broistas are incredibly successful. We feel, I think, really most proud of the service that we are providing along with mobile order. So feel really good about the pace at which this is growing right now. And, as far as looking at incrementality, we really view that in 3 different ways. We've shared from the Dutch Rewards perspective, we can measure what happens before and after. As we move through that, we are seeing as we add more cohorts that the most likely to order cohorts get added first. And so see a little bit of a drop in that, but still very pleased with that incrementality that we're seeing directly from Dutch Rewards. The second piece is that we continue to see that increase in the Dutch Rewards program. So new members joining and immediately making a mobile order. So really likely joining because of mobile order. And then finally, where you started, those throughput opportunities. So customers coming through the lines and seeing that it's a little shorter or there's less time. And so we're really pleased across the board with what we're seeing from a mobile order perspective.
Good stuff. Thanks, Christine. Congrats.
Thank you.
Our next question is from Chris Ogle from Stifel. Please go ahead.
Yeah, thanks. Good afternoon and congrats on a strong finish to the year. Josh, the company's CapEx target for 25 is lower than we expected. And I know you mentioned CapEx per shop was 1.8 million in the fourth quarter, but what's the company expecting for 2025 in terms of cash outlay per store? And is leasing the primary reason for the lower cash outlay, or are there some other cost savings as well?
Yeah, thanks for the question. Yeah, our focus on driving down the per unit CapEx is really shifting the lease components, so shifting to greater proportion of build-to-suit leases. We are making progress in that way and certainly have focused on that in 24 and into 25, and we'll start seeing the benefits of that as we move ourselves into 25. I think we'd shared previously that we expected that 2024 would be kind of our peak per unit CapEx. So we're expecting to see that come down. We are expecting to be able to provide you guys a little bit more granularity and specificity of that as we get into our Investor Day conversations, but that's what's really driving the CapEx outlook.
Do you expect additional lease arrangements to impact the shop level margin this year? And how should we think about it impacting the long-term margin goals, I think, which are in like the high 20% range?
Yeah, I mean, certainly it is a factor as you're referencing build-to-suit leases tend to be higher rent than the ground lease. That's factored into the guidance we're providing. So, what we're seeing is included in the overall guide for our EBITDA guide for the year. I think over the longer term, it's something as we share a longer term trajectory, something we can provide more specificity on at a later date.
Great. Thanks, guys.
Next question is from Andy Barish from Jefferies. Please go ahead.
Hey, guys. Yeah, tough to find anything concerning, but it was with the 25 company openings in the quarter was the lowest number since the IPO. Is that just kind of the kind of end result of some of the work done over the past year? And then I think you made some commentary around openings picking up in the back half of the year. At least historically, the 1Q has been the highest number of openings annually on the company-owned side. Can you just kind of give us a little bit of the shape and help us level set on the modeling there?
Yes. So as we look at the year, we're really pleased with the market planning efforts we've had and the impact that they've had on that new shop productivity. One outcome of that is just shifting some of the units out towards the back half of next year. So as we look at Q1 and Q2, they'll be at about 30, really similar to Q4. And then as we will ramp as we go into Q3 and Q4 of next year. And again, that is really an outcome from the market planning efforts we've done over the last year and a half to really shape that pipeline to drive that new shop productivity and to lower the unit CapEx for those units, which we're incredibly pleased with the results that we're seeing from that.
Got it. And then just one quick follow-up, Josh, on the 2 to 4% guide for system same-store sales. Should we expect the company-owned to continue higher, or just given the lapse, will that kind of normalize a little bit?
Yeah, I mean, we have over 2024. What I'd say is we have seen that spread of company performance stronger than the franchise performance. Part of that being the contribution of those newer markets. We're just growing faster on the company side than we are on the franchise side, and that contributing certainly to the performance that we've seen overall. But that has contributed to the spread. So I'd expect there to remain a spread throughout 25 as well.
Thanks, guys.
Next question is from Andrew Charles from TD Cowen and Company. Please go ahead.
Great. Thank you. Josh, can you expand a little more on how you came up with the 2 to 4% same-store sales guidance for 2025? You talked about how that's the right level to think about lapping 1Q, your toughest comparison of the year. With all the good stuff you guys have going on for 2025, mobile order mix is increasing. The advertising is obviously paying off. How did you come up with the 2 to 4?
Yeah, I mean, so I guess the few things I'd highlight is as we think about that full year, we're coming over a little over 5 for 2024. We're all rolling off a net of about 3 points in price. So that certainly will just take down the ticket side. I think as we think about the trajectory through the rest of the year, we have factored in the performance we saw in Q4. We factored in the strength we've seen so far in January. We do have the lap of Q1, the tough lap in Q1. So when you put all those pieces together, we are assuming that does drive some positive traffic, which we're very pleased with and very encouraged with, just given the momentum we've seen. But do feel really good about what the ability to be able to drive that 2 to 4 despite the lap we have in Q1 and what we've seen today.
Okay, great. And then Christine, at a high level, how are you thinking about the advertising plan for 2025 versus 24? What are the ways that you can build on the success that you've seen, while perhaps as you grow the budget, new opportunities that would afford you? And I'm also curious, is embedded within the guidance, EBITDA guidance, is there a step up in advertising and % of sales embedded in that as well?
Yeah, so as we look at 2025 and what we're going to do from an advertising perspective, we've learned a lot in 2024, which we will apply. So I think we continue to get smarter about which channels work best, what we should put in front of our potential customers, and really have honed in on how we're using paid advertising to find new guests and then trying to get them into the rewards program as rapidly as possible so that we can speak directly to them with that rewards program. We did begin testing some increase in paid advertising in our mature markets towards the end of the year. So we're pleased with early results there. And, as we look at the year, I think we will continue to understand how we're driving ROI across our advertising efforts. And if we see opportunities to step that up, we might lean in.
Very good. Thank you.
Next question is from Sara Senatore from Bank of America. Please go ahead.
Yeah, hi. Thank you. Quick housekeeping and then a question on new store productivity. You mentioned 3 points of prices rolling off. So you had, I think, 4 points in the quarter. I just wanted to confirm that. And then, as you think about 2025, that implies pretty modest pricing. And then the question is on new unit productivity. I mean, Christine, you mentioned how strong it's been. This is the first quarter, and it's always kind of confounded by opening timing, where it actually looks like maybe the new unit productivity is perhaps even higher than the system average. I guess if you could just speak to that and maybe anything you're seeing early days in Florida. Thanks.
Yeah, so I'll start with your pricing question. You're right. So we had about 4 points of price in Q4. It was a bit more than that for the full year, but we are rolling off a net of 3 for the full year as we go through the year, which does imply very modest price, incremental price coming in on for the balance of 25.
Yeah, and on new shop productivity, we were very pleased with the fourth quarter. As we look overall, some of the openings, we have had some very, very strong openings in Southern California. And so as some of those came into the system, just saw the results from that. So definitely pleased with what we're seeing. And then as far as Florida, still really early days, but very excited by what we're seeing from a customer reception. Last week, I was just at one of our openings in Florida, and amazing to see that folks were waiting in line at 11 p.m. the night before we opened. And just a neat reception to see in a very new market, very far away from where it all started.
Yeah, certainly. What we saw was very exciting. I guess if I could just sneak one more in, does what you're doing with advertising or real estate strategy, does that change how I should think about sales transfer? Something that, I think you talked about last quarter, but not this quarter. So just as I look at traffic.
Yeah, I mean, I think as we've shared before, we feel comfortable with sales transfer in the range we've talked about previously. As we are opening shops and creating greater convenience for customers, that's going to result in some intentional transfer. So I think, I feel good about that range. Over time, certainly as we grow and that comp base grows, it will come down. So again, very consistent with what we've referenced in the past.
Thank you.
Next question is from Jeffrey Bernstein from Barclays. Please go ahead.
Great. Thank you very much. My first question is just following up on the 2025 unit pipeline. And clearly comps come and go depending on the consumer and promotions and whatnot, but the unit growth is obviously the key driver of the top line. So can you just talk about, the mix of new versus existing markets, and maybe you can compare and contrast Florida versus Texas performance? Sounds like you're pleased with Florida. I know you have a more of a refined new market approach. So just trying to get a sense for that white space opportunity and maybe comparing and contrasting those two big markets that you had a different approach in. And then I had one follow-up.
So we're just getting started in Florida, and I would say the learnings from Texas were, as we go in, we will still go in with the same number and the same penetration into the market. We just might time it over time a little bit differently, and so we are pleased with what we're seeing from that so far. But this is certainly, we have customers that come to us quite often, so we can put shops quite close together. We will open some new markets next year, but we continue to have a lot of infill still in our existing markets as we grow. So Florida, I mean, we are like at 7 or 8 shops right now, so we are just getting started in the state of Florida, and we'll have some new cities that will open in next year as we go. And I do think at our Investor Day, we're going to share a little bit more about how we're performing in some of these newer markets as well.
Great. And then just following up on the coffee cost question, Josh, I think you said 110 basis point headwind in 25, but I got the impression, I guess you're thinking that pace of the headwind accelerates through the year. So I'm just wondering how we should think about that, whether there's any potential for contracting to mitigate, or whether at some point you would consider incremental pricing to offset. I know you mentioned you're really not planning on taking much, but just curious why, the thought process around whether it makes sense to take or whether you're trying to protect your value scores or how you think about that. Thank you.
Yeah, happy to talk to coffee a little bit. So the 110 basis points you referenced is the company margin impact that we're expecting. I'd add to that there's a franchise margin as well. So overall adjusted EBITDA margin impact, we were expecting to be about 150 basis points. For purposes of guidance, and as we've looked at this, I'm guessing not all of you are in the coffee market as much as maybe I am, but coffee's been trading at very high levels. We've, for modeling purposes, assumed that it maintains about $4 for the balance of the year. For historical context, and even 24, we were closer to the $2 mark per pound. So, substantial increase year over year. We are, if you were to look at the future curve and look at how that might shape up, the future market would suggest that it might come down in the back part of the year, but we're assuming that it holds at that $4 for the balance. As we think about this longer term, history in the coffee market would suggest that these are temporary spikes that should not have a prolonged impact. And therefore, as we think about pricing, we're taking the longer view of making sure that we maintain our value proposition, make sure we're taking a pricing, according to the overall structure of the business. If for some reason the coffee prices were to be a more structural change, a more foundational change that were to be more persistent, certainly there's other factors we could look at considering, price being one, and then potentially other offsets in the P&L. So it's one it's been incredibly volatile, especially more recently. It's one we'll just keep you guys updated on as we progress throughout the year.
And Jeff, the only thing I would add to that is our customer value proposition is really strong right now. And when we look at what's driving our performance overall, we continue to feel incredibly good about where we are in that space. And so I think from a price perspective, we have great shop level margins. And so ensuring that we're continuing to provide our customers with the incredible value that they see today is a top priority for us.
Makes total sense. Thank you.
Next question is from John Ivankoe from JP Morgan. Please go ahead.
Hi, thank you. I wanted to get back to the topic of using paid media for existing legacy or maybe even more mature markets. What is the I guess addressable need that you think that marketing would actually achieve?
All right, ladies and gentlemen, I think that's sufficient enough. I think we heard the majority of the Q&A. I think it's obvious here as we get through Florida. There's 7 to 8 locations that just opened up in there. We'll see how the rest of the Eastern Coast goes. There's no stores that have been opened up in the broader north part of Florida, but I guess it's to say, or north of Florida, I should say. There's obviously stores in Florida. Let me see where the latest. It's been a minute since I've checked about. So no real big stores opening up here in Houston. We could see one opened up in Alabama. I think that might have been there though, but we have one opening up in Daytona Beach. Let's see. Have they opened up? No, I know that they're building stores in Georgia, but I've yet to see any open up. We're starting to see Kentucky. Those have been around for a little bit. So I'm curious. They did say the opportunity for 7 or 8 more markets within. So that might necessarily not be what's the word I'm looking for? Sometimes, man. Hold on a sec. Might be like specific cities or something like. Doesn't necessarily need a new market. Is, let's say, Texas or Florida, meaning states. So that's something that could be clarified a little bit as well. But for me, I think it's a good opportunity. We'll see with respect to how well Florida is doing, which seems to be going well. How potentially the rest of the East Coast may go. I know there's more competition. A lot of people are afraid that competition is going to increase as we go on to the East Coast with Dunkin' Donuts. It's definitely a Dunkin' Donuts stronghold. Starbucks is throughout the rest of the country as well. Starbucks, obviously, in the Northeast as well. So, yes, it's interesting to see what happens going forward with respect to Dutch Bros. So, thank you all. Really hope you guys enjoyed this one, and we will catch you on the next conference call. Much appreciated, and I'll talk to you guys soon. Cheers.